So the Fed gets its money back. And when the Fed gets money back, that money just evaporates. The Fed doesn't need to keep any money because it can make all the money it wants anytime it wants to. So it's a bit complicated to explain in just a few sentences, but the bottom line is it's the opposite of quantitative easing. Quantitative tightening destroys money, and that tends to make stock prices fall. And we're about to get a heavy dose of quantitative tightening coming into effect within the next couple of months.
And it's going to make it harder and harder for mom and pop to go buy that house they're going to flip.
And isn't that going to drive inflation through the roof?
Well, they think the opposite. When they, instead of printing money, that's the thing that normally causes inflation. It stimulates the economy, it creates growth. But when they destroy the money, that tends to make asset prices fall, like stocks and property. So people are less rich, so they spend less money. And if they spend less money, then prices tend to fall. So that's why they're doing this. They're worried now that the inflation rate has moved up to 7%, and they're taking steps to bring it back down. But what they may find is this could cause a significant stock market crash. And some of the high-flying stocks got hit a whole lot harder than that.
Look at Meta or Facebook, whatever those I call now, they tanked.
Destroying $230 billion of American wealth.
There goes your 401k, sweethearts. And that's why I spoke out against 401ks forever. And then all you guys who are you're planning on renting your property, people won't be able to afford the rents. That's what it means.
Well, so total credit is equal to total debt, because one person's loan is another person's debt, right? So the two have to equal each other. So one way of thinking about this, the easiest way to think about it, is all the debt in the country. Government debt, household sector debt, corporate debt, financial sector debt, all the debt. It first went through $1 trillion in 1964 when I was 4 years old. Now it's $90 trillion, from 1 trillion to 90 trillion during my lifetime. And this credit explosion, which would not have been possible if we had remained on a gold system where dollars were backed by gold. But this explosion of credit has transformed the world.
Wait, Richard, hang on. You're speaking like an economist again. Credit is what the Fed and the Treasury allow people to get to the big banks like Wells Fargo and all that. And that credit then allows people, the banks, to send out debt. So then corporations and individuals come in and they take credit and they turn it into debt, but it's the same thing. So by creating credit, debt could explode. Am I correct on that or incorrect?
No, I think you put that exactly right.
Yeah, credit's not a word people use. They use credit card, but they think about debt, their household debt. So that's what I'm saying. We don't teach economists. We teach everyday mom and pop who is trying to speculate on their 401k or their house.
The reason I tend to use credit is because I say this system that we have now is not capitalism, it's creditism.
Yes.
Creditism sounds better than debtism. I tried that. Creditism works better. Capitalism to creditism. Because credit growth drives economic growth now. We're dependent on it.
Yeah, what Richard is saying is the way America grew was because we produced products. Now we don't produce products, they create credit or debt. Am I correct on that one?
That's right. Instead of our economy being driven by investment and savings as it used to be, it's now driven by credit creation and consumption, and more credit creation and consumption. And that's been great. The problem is it requires credit growth to survive. If credit contracts, we have a depression. And that has made us dependent now on government borrowing and government spending to keep us out of depression.
So if you're going to buy, I don't know how many people, I took your advice. I bought a house. I'm going to make some money. I said, at the top of the frickin' market? And what about all these guys in this 401ks? 401ks came into existence in 1974. It was called ERISA. And I've been speaking out against 401ks because I will get censored with this one. But 401ks are like a condom. It gives you a false sense of security while you're being screwed. Do you know what I mean? And if this market crashes, when they raise these interest rates, if they do, your 401k turns to 201k. Just as you get ready to retire, all you old guys like me, hear what I'm saying?